Hello, I'm Kern Alexander, Professor of Banking and Financial Market Regulation at the Florence School of Banking and Finance. Today I will speak to you about banking regulation and environmental sustainability. Environmental sustainability is a broad concept covering climate change, biodiversity loss, and ocean acidification. Environmental sustainability is a threat to financial stability, and it's something that bank regulators should be concerned about. Bank regulators can support the banking sector in managing the transition to a more sustainable economy by using certain regulatory tools, which I'm going to discuss. But first we must address the risk. There are physical risk, transition risk, and legal liability risk which banks are exposed to. Physical risk is the potential impact of environmental phenomena on the banking business. The fact that intense weather storms can lead to banking sector losses. Transition risk deal with changes in government policy. The changes in policy can lead to banks having to hold higher capital requirements for loans they make to unsustainable sectors of the economy. And there are legal liability risks that are concerned potential liability for lawsuits and regulatory enforcement actions that can be brought against banks for failing to manage environmental risk adequately. How do regulators help banks address these risks? Regulators can do so by requiring capital levels that are adequate to manage these risks. For banks that make loans to unsustainable sectors of the economy, regulators can require higher capital requirements. This is called a Brown penalizing factor. For loans that banks make to sustainable sectors of the economy, regulators can require that banks hold lower levels of capital. This is known as a green supporting factor. Another important area where regulators can help banks concerns bank corporate governance. Regulators can supervise and monitor the types of business models that banks are using to conduct their business, to see if they are selling products to their customers that involves investments into sustainable sectors of the economy. Bank corporate governance and leadership is an important area which bank regulators play a role in overseeing. Banks also regulate risk management, and they regulate the setting of stress tests. So bank regulators have a large number of options they can use in overseeing the governance of banking institutions. Another area where regulators have already begun to do a lot of work is by adopting disclosure standards. These disclosure standards require banks and other financial institutions to disclose their potential exposures to environmental risk. This is now being undertaken by international bank regulatory authorities in the Basel Committee and in the European Union under the Capital Requirements Regulation. International regulatory bodies are also contributing to the regulatory debate. The International Monetary Fund will, in 2024, begin to require countries to put environmental stress testing into bank regulatory models. The Basel Committee has adopted new principles regarding risk management, internal controls, and adequate capital and liquidity for banks to manage environmental risk. So altogether, regulators are playing a greater role in influencing banks to manage their business in a way to withstand the impact of environmental sustainability phenomena. So there needs to be a greater dialogue between banks and regulators about how best to do this. Bank governance is very important. Leadership from senior management is vital to create a business approach which banks can use to help manage these risks in the future. Regulation has an important role to play to prevent the market failures that are associated with environmental sustainability, such as climate change. and regulation will be evolving in the future to place greater emphasis on how banks manage these risks.